Lucid Group announced third quarter financial results that sent the stock down 10% after these earnings were announced. So in this video, I'm going to update my recommendation of Lucid stock. Coming into this quarter, I did not have the stock rated as a buy. I suggested that this stock was a hold or a sell, not a buy. And so you're going to want to tune in to see if I'm updating that recommendation. So let's start with the review of Lucid's third quarter results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the big picture, the big item that came out of Lucid's third quarter results was a decrease of the annual production target. Lucid lowering its 2023 target to a range of 8,000 to 800 vehicles produced. That was from a prior target of 10,000 units in the previous quarter. They had announced that, but even before that, they had announced the target of between 12,000 and 14,000 units for 2023. So this is their second downgrade of their annual production target. This is a result of decreasing consumer demand. There just isn't the demand available for Lucid's cars, and so it's lowering the production to match with demand. It doesn't want to just make these cars and have them sitting around in inventory. It wants to make cars that it can sell. So it is a prudent decision to decrease the production. Still, it's not good news for Lucid stock investors that customers are not buying their cars. Just a little while ago, maybe I would say 4 or 6 quarters ago, Lucid was mentioning that they had so much customer demand that they couldn't produce enough to meet that customer demand. And now, a short while later, they've got too much production capacity, not enough consumer demand. This is a bigger problem to have. You'd rather have the problem of having too much customer demand instead of having not enough customer demand. So, Lucid also announced that the production of Lucid Air Pure rear-wheel drive began in September and it's in the process of ramping up. Production of the Lucid Air Sapphire also began in September, and that's completing the Lucid Air lineup. Lucid is hoping that these new models will spur consumer demand. Additionally, Lucid is launching the Lucid Gravity, the company's all-new luxury SUV. That'll be unveiled on November 16th at the LA Auto Show, and the start of production remains on track for late 2024. Interestingly, SUVs, electric vehicle SUVs, are in strong demand. Looking across the board, Tesla's Model Y is one of the best-selling SUVs in the world, and Rivian, one of Lucid's rival EV manufacturers, has said that demand for its SUV is stronger than demand for its pickup truck. So it looks like consumer demand for electric vehicle SUVs is holding up relatively well compared to regular electric vehicle sedans. Surprisingly, Rivian's revenue of 137.8 million was down by 30% year over year. Revenue was down 30% year over year. And of course, with revenue down year over year and operating expenses holding relatively flat at 895 million, which increased 0.6%, the net loss decreased by 19% to 630 million. The good news for Lucid stock investors is that Lucid management is adapting to the decreasing rate of customer demand. It's decreasing production. It's operating more prudently to account for the fact that there's slowing customer demand. And so the company is reducing some of its charges, reducing some of its expenses. Cost of revenue decreased by 4.6% to 469 million in the quarter. Loss from operations of 752.9 million was an improvement of 9.5% year over year. Gross profit loss of 331.9 million was an improvement of 11.7% in the quarter. So other than decreasing consumer demand, Lucid management is doing a good job improving the operations of the business as it's ramping up and learning about how to operate its business more profitably and more effectively. So despite these losses on the bottom line, Lucid is in a relatively decent position. The company has over $1.1 billion of cash and equivalents and over $3.2 billion of short-term investments. So the company has time to achieve profitability on the bottom line. It doesn't need to achieve profitability tomorrow. It's not in danger of going out of business anytime soon because it has such strong cash balances in the bank account. If we look at Rivian's cash flows from operating activities in the 3 months that ended September 30th, you'll notice that the company improved cash flow from operations despite decreasing revenue on the top line. Net cash used in operating activities improved to a loss of $513.5 million. That was better than the loss of $569 million in the same time the prior year. The main reason why Lucid made this improvement is a decreasing amount spent on inventory. So the company reduced the amount of production, as was highlighted earlier, lowering its production target to match better with customer demand, and that decrease is helping its cash flow because it's not using that much cash to build up the inventory. So again, like I mentioned earlier, management doing a good job adjusting to the realities of the business now that customer demand is not as strong as they initially thought it would be. In fact, nearly every EV automaker is waking up to the reality that customer demand for EVs is not that strong, especially if you strip out that incentive from governments incentivizing consumers with thousands of dollars of tax credits to purchase EVs. However, for Lucid, that's not applicable. Their cars are too expensive to qualify for these tax credits. Still, other EV automakers that do qualify for these tax credits are still having to lower prices to spur customer demand. Customer demand is just not that strong. Briefly, during the earlier stages of the pandemic, when legacy automakers were supply constrained and they couldn't produce the totals of cars that they wanted to, customers needed to buy cars, and EVs were one of the things that were available, so they were buying them, right? But now that legacy automakers have fixed their supply chain problems and they're increasing production of legacy cars, people are saying they'd rather buy those cars than buy an electric vehicle. They cost less, they're more convenient, and so they're choosing those over EVs that cost more and they're less convenient. Charging takes an eternity compared to when you're filling up gas, and so the industry is troubled, to be sure. And so finally, looking at Lucid's forward price to sales ratio, it's down 92% off its high. Of course, I would argue that the valuation should have never been as high to begin with, but that's besides the point now. Looking at it today, if I was to update my recommendation of Lucid stock, I would still say the stock is not a buy. It's got a long way to go in order to prove that it can operate this business profitably, it can operate this business sustainably before I can recommend the stock as a buy. But before I let you go, if you gained any value from this video, please subscribe to the channel. It'll really help me make more videos just like this one.